Unit 2, the Regulatory and Conceptual Framework of Accounting. Section 6, Accounting Concept and Conventions. 2. By the end of this session, you should be able to describe the following accounting concepts: business entity concepts, double entry concepts, money measurement concepts, periodicity, historical cost convention, materiality concept, realization concept, matching concept, and objectivity concepts. Other accounting concepts: business entity concept, double entry concept, money measurement concept, periodicity, historical cost convention, materiality concept, realization concept, matching concept, and objectivity concepts. Business entity concept. The business and its owners are two separate existing entities. Any private and personal incomes and expenses of the owners should not be treated as the incomes and expenses of the business. The investment in business by the owner is shown by way of owner's capital or claim over business assets. Dual aspect or double entry concept. This concept states that each business transaction must have two effects which are equal and opposite, such that the accounting equation will always hold. Double entry is the name given to the method of recording business transactions so that the dual aspect of the concept is upheld. The golden rule of double entry bookkeeping is stated thus: for every credit, there must be a corresponding debit and vice versa. Money measurement concept. All transactions of the business are recorded in terms of money. It provides a common unit of measurement. For example, market conditions, technological changes, and the efficiency of management will not be disclosed in the account. They do not have monetary value or cannot be quantified in monetary terms. Historical cost convention. Assets should be shown on the statement of financial position at the cost of purchase instead of current value. This convention provides an objective, reliable base for financial reporting. For example, the cost of property, plant, and equipment is recorded at the date of acquisition. The acquisition cost includes all expenditure made to prepare the asset for its intended use. It includes the invoice price of the asset, freight charges, insurance, or installation costs. Materiality. An item is described as material if its omission or misstatement has the potential to influence economic decision. Thus, immaterial item in a set of account is one too trivial to affect the reader's understanding and perception of the account. Materiality, therefore, is an issue not so much of size but of significance. Immaterial amount may be aggregated with the amount of a similar nature or function and need not be presented separately on the statement of financial statement. Materiality depends on the size and nature of the item. For example, small payments such as postage, stationery, and cleaning expenses should not be disclosed separately. They should be grouped together as sundry expenses. The cost of small valued assets such as pencils, sharpeners, and paper clips should be written up to the profit or loss account as revenue expenditures, although they can last for more than one accounting period. Realization concept. The realization concept states that sales or revenue are normally recognized when the goods being sold passes to the customer or the service is rendered and is accepted by the customer. Therefore, profit is normally recognized at the time when the goods or services are passed to the customer and he incurs liability for them, date of payment, or when the contract is signed. Revenue should be recognized when the major economic activities have been completed, and sales are recognized when the goods are sold and delivered to customers or services are rendered. Matching concept. The matching convention asserts that expenses should be matched to the revenues to which they relate, such that both the revenue and the associated expenses incurred in earning the revenue are recognized in the same accounting period. An effect of the matching convention is that assets stated in the statement of financial position provide details of unexpired cost to be allocated to future accounting periods. Objectivity. Accounting statements should be based on facts and not opinion. The accounting information should be free from bias and capable of independent verification. The information should be based on verifiable evidence such as invoices or contracts and not hearsays. Example, the recognition of revenue should be based on verifiable evidence such as delivery of goods or the issue of invoices. Concept of accountability. Accountability refers to managers and employees being held answerable for the utilization of an organization's resources entrusted to them. Need for accountability. To ensure that the owners of the business get good returns on their investments. 2. To ensure judicious use of an organization's resources. 3. To build trust between owners and managers. 4. To provide information to regulatory agencies such as the Domestic Tax Revenue Division of the Ghana Revenue Authority, and to assure stakeholders of good governance. Mechanisms for ensuring accountability. 1. By the setting of the audit committee, establishing internal controls, and drafting a code of business ethics that should be binding to all members of the organization. In this session, we discuss the following concepts: business entity concept, double entry concepts, money measurement concept, periodicity, historical cost convention, materiality concept, realization concept, matching concept, and objectivity concept.